Before we begin, subscribe to the channel and share in the comments how you think people were paid in a world with no banks and no paychecks. Now let us step into the year 1411, where money existed entirely in physical form and trust was built on metal, reputation, and risk. In 1411, most people never entered a bank because public banks in the modern sense did not exist. There were no checking accounts, no salary deposits, and no paper currency backed by a central institution. Money was metal. If you wanted to know its value, you weighed it. Silver and gold coins carried worth based on purity and mass, not printed numbers. Daily transactions depended heavily on silver pennies and regional coinage. Each territory minted its own currency, often with different silver content. A coin accepted in one town might be discounted in another. Traders constantly calculated exchange values, sometimes losing small amounts with every conversion. Trust depended on knowing the reputation of the mint that produced the coin. Barter remained common, especially in rural communities. A farmer might exchange grain for tools or livestock rather than use coin. In areas where silver was scarce, goods themselves functioned as currency. Cloth, salt, and even livestock carried recognized value. Money was flexible, shaped by availability. Most workers did not receive steady wages. There were no monthly salaries transferred into accounts. Laborers were paid per day, per task, or per project. A mason building part of a wall received payment after measurable progress. Agricultural workers might be compensated with food, lodging, and small coin amounts at harvest. Payment was immediate and physical, handed from one person to another. Guilds controlled much of urban economic life. Craftsmen belonged to regulated associations that determined pricing, production standards, and apprenticeship terms. An apprentice might work for years before earning independent income. Masters negotiated contracts directly with clients, often receiving partial payment in advance and the rest upon completion. Debt existed, but it did not appear as digital numbers on statements. It was recorded in ledgers, on parchment, or even through tally sticks marked with notches. Reputation was critical. A merchant known for honoring obligations could secure goods on credit. A reputation for delay or default could close doors quickly. Wealth was rarely stored in loose coin alone. Land, livestock, stored grain, textiles, and precious metals served as long-term security. Hiding silver in a chest inside a home was common, but it carried risk. Theft meant irreversible loss. At first glance, the system appears primitive. Yet beneath the absence of banks and paychecks, a complex network of exchange was already forming, one that would soon evolve in unexpected ways. The turning point in understanding money in 1411 appears when we look beyond the marketplace stall and into the counting houses of powerful merchant families. Although there were no public banks with marble counters and guarded vaults, private financial networks were already operating quietly across Europe. Wealthy merchants extended credit to partners in distant cities, creating systems that functioned much like banks without ever calling themselves that. Carrying large quantities of silver across long distances was dangerous. Roads were unsafe, and ships were vulnerable to piracy. To reduce risk, merchants used bills of exchange. A trader in one city deposited coin with a trusted associate and received a written document promising equivalent payment in another city. The paper itself held no intrinsic value, but the reputation behind it did. This allowed trade to expand without physically moving heavy metal across every mile. Money changers became essential figures at fairs and trade hubs. They examined coins for weight and purity, clipped damaged edges, and converted currencies from one region to another. A skilled changer could detect counterfeit pieces by sound, touch, or visual inspection. Fraud was constant. Some individuals shaved thin layers of silver from coin edges, gradually reducing weight while keeping the stamped face intact. Over time, this clipping undermined trust. Rulers also manipulated currency. When monarchs needed funds for war or construction, they sometimes reduced the silver content in newly minted coins while keeping the face value unchanged. The result was gradual inflation. People noticed that prices rose even though coins looked similar. Confidence in currency depended not only on metal, but on political stability. Religious doctrine influenced lending practices. Charging excessive interest was condemned in many Christian regions, creating tension between moral teaching and commercial necessity. Merchants developed creative partnerships to distribute profit in ways that complied with doctrine while still compensating risk. Large projects required coordination beyond simple cash payment. Building cathedrals, financing armies, or equipping fleets demanded pooled resources. Partnerships spread financial exposure. Investors funded voyages in exchange for a share of profits, accepting that loss was possible if ships failed to return. By the early 15th century, record-keeping was becoming more sophisticated. In some commercial centers, double-entry bookkeeping improved accountability. Each transaction was recorded as both credit and debit, creating balance within ledgers. This innovation reduced confusion and fraud, strengthening long-distance commerce. Money in 1411 worked without modern banks or paychecks, yet it sustained expanding trade networks. Metal, paper promises, reputation, and careful accounting formed the backbone of an economy that was already more complex than it first appeared. In the final part, we will examine how ordinary peasants navigated this semi-monetized world and how these systems laid foundations for future financial transformation. For most peasants in 1411, coin was scarce. A farmer might go weeks without handling silver. Obligations to a lord were often paid through labor rather than money. This could include days spent repairing roads, harvesting crops on domain land, or providing livestock as part of rent. The economy at this level was semi-monetized. Coin existed, but it did not dominate every exchange. Taxes varied by region and status. Some were collected in silver. Others were demanded in grain, wool, or poultry. In difficult years, when harvests failed, fulfilling these obligations became nearly impossible. Debt accumulated quietly, recorded by local officials or remembered by landlords. Without access to formal banking, recovery depended on negotiation or additional labor. Urban workers experienced money differently. Artisans received payment for completed goods, sometimes partially in advance. Market vendors handled coin daily, but profits were unpredictable. A week of poor trade could leave a family struggling to purchase supplies. There were no fixed paychecks guaranteeing income at regular intervals. Economic security depended on steady demand and personal reputation. Wealthier merchants and landowners accumulated surplus in diversified forms. Land remained the most stable store of value. Precious metals offered portability. Textiles, spices, and stored grain could be sold during shortages at higher prices. Diversification was a survival strategy long before the term existed. Trust underpinned everything. Without centralized banking regulation, individuals relied on networks. A respected merchant could secure credit based on past reliability. A known defaulter could be excluded from markets. Reputation functioned as collateral. These early financial mechanisms laid foundations for transformation. Credit instruments, bookkeeping systems, and merchant partnerships gradually expanded in scale. Over time, some cities would establish public deposit banks to stabilize trade and manage currency flow. But in 1411, the system remained personal and physical. Money was touched, weighed, inspected, and guarded. There were no salary deposits arriving automatically. Payment required presence. Coin changed hands directly. Ledgers recorded obligation. Wealth was visible in land, livestock, and metal rather than in abstract numbers stored electronically. Money in 1411 worked through metal, memory, and mutual reliance. It sustained cities, financed wars, built cathedrals, and fed households without modern banks or paychecks. Beneath its apparent simplicity was a growing complexity that would eventually reshape global finance. The seeds of that transformation were already present in the coins, contracts, and careful calculations of the early 15th century. Over time, the pressure of expanding trade routes, growing cities, and increasingly complex partnerships pushed financial practices beyond their traditional limits. Merchants traveling between Italian city-states, the Low Countries, and parts of France and England demanded safer and more efficient systems of exchange. Handling sacks of silver was slow and dangerous. Written instruments became more trusted, and accounting methods more refined. As record-keeping improved, commercial confidence strengthened. Double-entry bookkeeping allowed merchants to see profit and loss clearly, balancing accounts with greater precision. This reduced disputes and created a more stable foundation for long-distance ventures. Investors could evaluate risk with better information. Partnerships expanded beyond family circles into broader commercial networks. Yet for the majority of the population, daily economic life remained grounded in tangible exchange. A laborer finished a task and received coin in hand. A farmer delivered grain as rent. A craftsperson negotiated price face to face. Wealth was counted physically, not displayed on paper statements issued by institutions. The absence of modern banks did not mean the absence of financial intelligence. People understood value, scarcity, and risk intimately. They diversified assets when possible. They protected reputation carefully. They adapted to debased currency, fluctuating silver content, and shifting political demands. Economic awareness was practical and immediate. By the early 15th century, Europe stood at a transitional point. The foundations of banking, credit expansion, and financial centralization were forming quietly within merchant networks. But in 1411, money still functioned through metal, contracts, and personal trust. There were no paychecks arriving at regular intervals, no automated deposits, no guaranteed income streams. Every transaction required presence. Every agreement required memory or written proof. Every coin carried weight that could be measured and doubted. And yet this system sustained trade across continents, financed wars, built monumental architecture, and supported daily life. Money in 1411 worked without the structures we consider essential today. It was physical, negotiated, and deeply personal. From these grounded beginnings would emerge the financial institutions that later generations would take for granted.